Hello, everyone, and a very warm welcome to today's Major Markets Update for Friday, January the 10th, 2025. In our previous webcast, we showed that it is messy out there, and we provided several, unfortunately, several, I must say, possibilities. That is when we start to see this overlap, and the Elliott wave is not the strongest method to analyze where exactly things are going next. So I did point out that we have to remain patient. And indeed, we did not get a bigger bounce at all. The futures market a little bit more, but it didn't show up in cash. And indeed, we went lower. Remember, we thought that we would go a little bit higher and then lower again. Well, that little bit higher just didn't materialize. And, markets are crashing between parentheses based on good news. We have good news. We have a lowered unemployment rate and more jobs being added. May the data be right or wrong, that's something else, but you can see that the market responds negatively to it. In a bull market, we, of course, get such positive news in a rally. Now we don't get a rally, supposedly because now people fret about interest rates, as if interest rates are all important. But they're really not. So in the end, what matters is price, and that the market is moving into a more complex correction. As we always say, after three waves lower, expect at least three waves back up. Similarly, in a bear market, after three waves up, expect at least three waves lower. Why? Because a simple zigzag, which is three waves lower, can morph into a flat. Zigzag is 3, a flat is then 3, 3, 5, A, B, C. Or a triangle, a 3, 3, 3. It can become a double triangle, or it can become a double zigzag as well. And that's probably what we're currently dealing with. So I do want to go back to the basics because I feel I've presented too many options for you. It became really an exercise of fighting all the opportunities, and I want to keep it simple. So we're going to toss a couple of ones out. Great if they're there, great if they're not, and really going to keep it simple. So how can you keep things simple? Well, that is, and I'm going to race through these slides because you know them by now, is by going to a simple line chart. Okay, a simple line chart is what we have for the regular NASDAQ. Okay, so we had the A, the B, and the C wave. As you can see, green A, green B. So we thought potentially all of this wave 4 has completed, or it is only an A, and this is a B and a C. Well, it did indeed morph into a double zigzag. We first had a simple single zigzag. Green A, green B, and then potentially in late December, I believe that was December 26, all of wave 4 had completed. But we now started to fill in a better Elliott wave trend channel. Remember, these are just simple closing prices. So we can still go a little bit lower. We can go as low as about 19,000 on a closing basis, possibly as low as, I would say, 18,600 on a closing basis. Intraday, we don't care anything about in this analysis. Okay? So this is why we say after three waves down, expect at least three waves back up. We don't see three waves here for this gray B. We don't see three waves here for green wave B. I'm thinking faster than I can talk. That's never a good sign. And now in gray C of green C of red 4. This is our primary wave count. I don't have a long-term bearish wave count for you. In fact, we'll at the end of this webcast go over potentially a much bigger bull market option, all right, to be determined, but I'll show you some reasoning on why. So now we're in gray C of green C of 4. This is a AB, ABC, a double zigzag. You can label this a WXY. I tried to refrain from WXY because we already have enough labels to not make it any more complicated than necessary. We have ABC, it can cover everything. We don't need to add another 3 letters, or soon we have the whole alphabet and all numbers to infinity to count waves. Let's keep it simple. The NASDAQ 100 chart is really simple. Once again, from the August low, I have a hard time counting 5 waves up to the December high. It's possible, but then the wave 4 is really disproportionate to the wave 2. So we don't like it. So here is then our NASDAQ 100 wave count. All right, let's start here with the daily chart, keeping it simple. We're not breaking above any warning levels for the bears, so we can pretty much lower them, which I've done. The blue one is now here at about 20,890. The gray one is now at Wednesday's high at about 21,250. The third one is still at the B wave high, and then the final one is of course at the recent all-time high. We're still well above the Ichimoku cloud and rising 200-day moving average, and you can see we're still trend channel surfing. So we have here the blue wave B, and let's see if I can find what we had originally. Here it is. So 4, alternatively A, and then potentially a 1, and then a 2. But we can't have a 1, 2 anymore because we went below the potential red wave 4 low. So the Alt A, Alt B, Alt C option is now fully in play. So that's what we've moved towards. All right. So what we thought could have been a wave 4 low is wave A, wave B, and now wave C is underway. And I've shown you here the ideal target zones for this fourth wave, somewhere around 20,200, 20,400. The red target zone is a normal fourth wave retrace. It can go a little bit lower, all right? It can go all the way down to 19,600 if it so desires. And then we have, of course, our ideal green C wave target zone and the blue one that we've already had on the chart. Okay, so if we look at the current correction, how much have we corrected? 6%. Way back in November, we said we're going to look for a 5 to 10% correction, somewhere around there, 5 to 7%. So nothing out of the ordinary. This is still well within the norms of having about a 5 to 10% correction every quarter. You get a 10, 15% correction about once every half year to a year. You get 20% plus corrections every so many years. Okay, so nothing yet out of the ordinary, still looking like channel surfing, and this still looks like a corrective double pattern to me. So we've lowered the warning levels for the bears. Nice, I like it. We'll keep it as is. So this is then the green wave B, topped where it had to. We'll take it off the table. Gray wave B, indeed, topped where it had to. We take that one off the table. We've not yet reached the other target zones for the C wave. So we have the length of wave A, of course, right there. And then you can see how can we then target the C wave. So C waves are normally equal to 1 or to A or potentially a little bit more. So we can drag this all the way down here. You see that? This is how low we can go. But for now, that seems quite far-fetched, I would believe. And then we go to the gray wave A right there. Okay, so we have the gray wave A, and we're going to measure it from gray wave B. So we have that right there. Okay, and then we have, of course, this blue C wave ideal target zone as well. So that looks really good to me. I'm going to take the blue C wave target zone away because we're now dealing with absolutes, meaning we have the A, the B, the A, the B in place. So here you are. What we do find, of course, is tremendous overlap here in this target zone. Okay, right there. This is then, I would say, the ideal target zone. Should we make that one blue? Sure, let's make this one blue. This is where we find most of the Fibonacci overlap for the gray wave, okay, for the green wave, so a little bit lower, and the red wave, there. So 20,400 plus or minus 100. Almost there. Doesn't mean we have to bottom there. We can go lower. We can go a little bit higher. But this is now the ideal target zone. And we're getting awfully close. We might get positive divergence here, okay? We have potential for it. It's not yet confirmed. This negative divergence I'm going to take away. This one as well. So there you have it. This is what we're going to look for the NASDAQ 100 to bottom ideally at about 20,400 plus or minus 100. So this is then the triangle that we're dealing with. And as you can see, this is another alternative. We first had this very shallow B wave, which was Wednesday's spike high. Not even a 23.6% retrace, okay? It doesn't have to be 50 to 60% retrace. It can be 23.6%. We didn't even get it. And we bottomed right here at this trend line. Trend lines are not the strongest technical analysis parts, but it shows you that we potentially bottomed already for this wave 4. So just want to point it out. Not really liking it too much, but okay. I'm just pointing it out right here. We need to break the warning levels for the bears are going to be, of course, much higher. This is the first one. This would be the second one, and the third and the fourth one. So these are the warning levels, bears, to tell us that indeed this wave count is correct. Okay, so for now, see it as an option with, of course, another variable, the A, the B, and the C, but I'm going to take that away for now. Okay, let's not complicate things too much. We're starting to see here potential double divergence, as you can see with the MACD, not so much on the RSI 5, and a little bit here on the money flow as well. So that's good, but divergence is only divergence. It's not a trade trigger, it's a condition. That's all it is. So we have to monitor it closely. The bigger the divergence, the bigger the counter trend rally at a minimum will be. Remember, after 3 waves lower, expect 3 waves back down. I do want to say at this point, other analyticians have this wave count as well, but I can also find 55 different other wave counts out there to try to elucidate this price action. So everything is still a little bit up in the air, with the daily chart being our primary focus. Okay. And again, the warning levels for the bears on a daily chart is, I think, what you should focus on. 20,900 is the first one, 21,250 the second one, and then this 21,700, the B wave high, and those ones. So if you so desire to short this market, I think the shorting is way behind us, but that's just my personal opinion. Then those are the levels we're going to watch, and we'll ratchet them lower if we indeed going to go a little bit lower. Here is a third alternative. I start to like it a little bit, is this ending diagonal wave C of 4, and we've just bottomed for wave 3 right at the 123.6% extension of wave 1 measured from wave 2. The wave 2 was done a irregular expanded flat. It's a little stretched, I would say, to the imagination, but yeah, it is possible. So again, the first warning level for the bears is that, of course, today's intraday high, I would say, right there. The second one is, of course, then Wednesday's intraday high. The third one would be this wave 2, and then ultimately, of course, all of wave 2, because this wave 4 cannot go above this potential wave 2. I like this reasonably well. Okay, this is not a bad option, and then we would bottom out somewhere around at 20,400. Okay, 20,400. Not too bad. Okay, not too bad at all. Let's move on to the S&P 500. So also here we had the potential for wave 4 having completed after a simple ABC lower. After 3 waves down, expect at least 3 waves back up, which is what we got. So the Alt A, Alt B, Alt C wave count is now operable. This is the one. This is now the double zigzag. So we have A, we have B, and this was what we originally had planned. Remember, green down, green up, green down. Well, it's turning into green down, green up, gray down. That we just simply cannot know beforehand. So have always a little bit of patience as these corrections continue. We've corrected 5% from the all-time high so far. So far, still a garden variety correction. Nothing out of the ordinary. Yes, we are below the Ichimoku cloud. We are below the 50, the 10, and the 20. The only thing that's holding us so far up is the trend line here and the 200-day moving average. So the chart does not look happy. Okay. Now, if we get a green reversal on Monday, that would be great. So that would further trigger double positive divergence on the daily chart. But so far, just a garden variety, 5% correction. And even if we go to about 5,600, we still have a rather reasonable garden variety correction. That's 7%. Already stated in November, we'll see 5 to 7%. Okay, so this is still very possible. 5,600. It's possible. It's not out of the ordinary. We can even go to 5,600 there. Some people say 5,500. I'll take it. Also, it's a 10%. Nothing yet too disordinary, so to say. Currently, we're at 5%. So we topped here for this blue wave, okay, and we're now racing towards this one. We're not really there just yet. I don't think so. It doesn't look really complete just yet. So let's see what we're going to get. So this is wave B. And then let's do the FIB analysis as we did for the NASDAQ 100. But now we're going to do it for the S&P 500. So C waves tend to be somewhere around 100 to 161.8. So here we have the whole range for this green wave C. Okay, that's the whole range. It's huge. It's anywhere between 5770 and 5600. Now we're going to do it for the gray wave A. Okay, so this is the length of the gray wave A. And here we go. And we're going to add that to our target zones as well. Anywhere between 100 to 161.8. 161.8. Here we go. And this is then the ideal target zone for this wave C, anywhere between 5800 and about 5660. Excellent. So there we have it. And now we're going to apply, similarly, a logical overlap of all these target zones in blue. So the ideal target zone is somewhere around 5775 plus minus 25. That's what we're looking for. So we're getting awfully close. Potential here also for double positive divergence. So we're going to change this, of course, warning levels for the bears. Okay? Because now we're starting to look for upside soon. So the first warning level for the bears is right here at about 58.27. The second warning level, I would place it somewhere around here. The third warning level there. So the second warning level should be there. And then the third one is, of course, the recent all-time high. So this seems to be a reasonable target zone for this wave 4. And then there's still the wave 5. Again, it's hard for me to count 5 waves up unless this was wave 3. But is it possible to have that as a wave 3? It's very short. Okay, it's very short. It's definitely not the shortest. But then this would be wave 4. It was so disproportionate. I don't like it. So we're not going to go with that. Hourly chart, we have reached the target zone for this wave 4, which was anywhere between 58.30 and about 57.50, I believe. Also here on the hourly chart, so this is then 57.55 and here 58.17, which matches, of course, really well with that blue target zone. So it's reached. So question mark if this wave 4 is completed. Are we going to see more positive divergence to be determined? Okay. Are we going to see more positive divergence to be determined? These are conditions, not triggers. Also here, a very shallow wave B. This is the retrace target zone with the lower end being the 23.6 and the upper end being 76.4. We didn't even get 23.6%. Definitely weak. Now, if we would do simple CSA relationships right there, you can see a little bit lower would not be out of the ordinary. And that would still allow, of course, for a fuller wave 4. Right in the target zone. Right there. 57.80, 57.75. Okay, so it starts to look reasonably good. The warning levels for the bears are going to be today's high. Here, we'll keep this one, I would say, right there. And then, of course, there. So those are the warning levels for the bears. And I'm going to do it this way. So then the last option we are looking for is similar to the NASDAQ 100, 345. Also, this one gets us somewhere around 57.25-ish, 57, 75-ish. Okay, so also this one is not completely off the chart, so to say. This one still looks pretty good. And also here we're going to do the warning levels for the bears on the map. And the gray one's going to be there. And then the orange one's going to be there. And then the final one is going to be there, because the wave 4 can, of course, not go above the wave 2 high. Okay, so these are the two short-term wave counts we are looking at. The first one is still a little bit lower for this final C of C target zone. We might see another 4, 5 setup, so to say, meaning 1, 2, 3, 4, 5. Also here, a little bit lower would not be out of the ordinary. 20,400 plus or minus 100 is the ideal target zone. Please focus on the daily charts. I think they are more reliable than the hourly chart. Why? Because we have less scribbles. The more scribbles you have, the more easier it is to misinterpret those. That's really the bottom line. I do want to point out we do have the possibility for a bottom already being in place as a triangle. Okay. Alternatively, we're going to do an ending diagonal. I think those are the two options that we're dealing with. Same for the S&P 500. We can move to the alternative wave count from the double zigzag. And again, we're getting awfully close to the ideal target zone for all of this wave 4. A little bit lower would not be out of the ordinary, but if we are going to hold the low, then we've completed a target of triangle in the target zone. And again, an ending diagonal would be not uncommon for the C wave. So now we're going to go over the big picture. Okay, we've gone from the hourly charts to the daily charts, but let's go over the big picture and wonder, are we really topping out in the bull market? Are we really? That's the question. Or is there a lot more upside to go? Here is the Dow Jones since the 2009 low. Okay, so we have primary 1, primary 2, major 1, major 2. Then the whole 2015-16 period was a major 4. Yes, markets can go sideways for quite a while and be frustrating for much longer. And then we had this 2-year primary 4 correction as a irregular expanded flat. Wave A was, as you can see here, a flat in itself. Wave B was a zigzag. Again, after 3 waves lower, expect at least 3 waves back up. And we got 5 waves lower for C of 4 into the COVID low. And then we had a massive rally, which could have been a first wave. Then we had a decline in 2022, which could be the second wave. And we're now in this wave 3. So this one suggests we can go a lot higher. Okay, we can go into almost the 60,000s for the Dow Jones. We just recently got pretty overbought on the money flow indicator. And at these levels, that's somewhere over, just a little bit over 80. Normally, the market retraces and then moves on. We're definitely not as extremely overbought as we were in 2018, not yet. But we had something similar here in the early 2000s, as you can see here, and further upside. Same here, further upside, and potentially further upside. So now we should be soon in a red wave 5, then a black wave 4, and another black wave 5. Okay, so just want to point out this is very possible that the whole rally from the COVID low into the 2021 high was wave 2, wave 1, wave 2, and now in 3, 4, and 5. Okay, this matches also with the yearly analysis that every down year is a corrective year. Unfortunately, stock charts, it doesn't provide us with the early 1920s anymore. It just gives us 100 years of data. I know this data is available. And you can just see here the slightest. So we had 1, 2, 3, 4, 5 for super cycle 1, super cycle 2. For all I care, you can call it major 1, major 2, potato, potato, as long as you label it a 1 and a 2. Straight up, cycle 1, cycle 2, and primary 2. And now we're counting 13 waves up into the 1966 high. That's an impulse. Okay, even if the 1970s high was wave 3, it's fine too. 17 is also a impulse. 5, 9, right? 13, 17. Then we had 9 waves up, meaning we had 1 down year, 2 down years, 3 down years, 4 down years, and 5 up, right? Up sequences. Makes an impulse, 9. ABC, because this rally here was 3 waves, 1, 2, 3. And then down. And now we are going all the way back. So you can see I've been able to account for every single wave on a yearly basis. Every single wave. So prove me wrong. Now we are in wave 7. So if this is indeed an impulse, we need 9. Okay, so that doesn't, that all of a sudden makes this not so far-fetched. Here we had 13, potentially 17 waves up. Okay, 9 waves up. So now we should see at least 9 because we have just done 7. So we might get a down year this year. Who knows, right? Or maybe next year. Who knows? That's fine. But so far we have 7 waves up. This was a down year. This was a down year. I don't care about the intra-year candles, okay? This type of stuff. Those long wigs, not candles, wigs. Doesn't matter. We just count down years. By the way, this is log scale, okay? Just to make sure that you understand, this is log scale, so we really can account for these earlier years with much lower values. 7, 8, 9. So I need an 8 and a 9 at a minimum to complete this super cycle 3. So indeed, the bull market might not be done yet at all. So please keep this in mind, okay? Please keep, I have 0 indication the bull market is done. That's my point. 0 indication. That's really the case. If anything, if this was major 1 and major 2, 2021 major 1, 2022 major 2, then we have intermediate 1 and intermediate 2. And intermediate 2, as you can see, took almost a whole year. And this was a irregular running flat, 3 down, 3 up, 5 down, with the 5 down not going below this. Running 1, 2, 3, 4, 5. So this is 3 of 3. Okay, so we're in 4. We're going to get another 5, a larger 4, larger 5. So maybe this black wave 4 will be a down year. So then we're currently still in 7. Then we get 8, and then we get 9. All right, not too bad on a yearly basis. So we're still in 7. Major 4 will be 9 or 8, and then 5 will be 9 in a sequence of 9 annual waves higher. Wonderful. So this would really shock a lot of people. Just those that think that we're going to crash to 0. Okay, we're not going to go to 0, and even if we do, don't worry about your money. We're all going to be dead. If the stock market goes to 0, there's no use for your money anyway. Okay, let's keep this in mind. How we're doing market breadth. Market breadth wise, yeah. It's, of course, the bears are in charge. AD line broke below this uptrend line. Not a good sign. Okay? Not a good sign. Don't like it. There's no indication of a bottom in place. How we're doing our long-term model? Well, the long-term model remains on a sell. It tried to get on a buy on the bounce, and it's back on a sell. So the bears are still fully in charge. That's for sure. How we're doing PMO? Well, they gave an interesting buy signal. It's probably going to switch back to sell. It happens. Let's go back a little bit in time, see if we have similar type of price action. Yes, we do. Okay, so we have here, for example, September of 2023. This was a fake buy signal. We had here March 2023, a fake buy signal. We had here December. Okay, so it happens. Same here, December, this one as well. It happens. Nothing works perfectly all the time. 60% of the time it works all the time. You have similarly here for sell signals. You get fake sell signals. They happen as well. Okay, so I think this buy signal will turn into a fake one, and then we simply reset the clock. How we're doing on the McClellan oscillator? Well, we're still only at minus 38%, which is much higher than where we were in December. So this positive divergence continues. So it feels like we're getting close to this October low type of setup, 22 here. Something similar, okay? And then the summation index is, of course, raising now soon below minus 500. Again, those are very rare occasions. Here is one, and here is another. And I do want to compare apples to apples, so I think it's better to compare a bull market setup with a bull market setup than a potential bear market. But even if it is a bear market and we're completely wrong, That was a very good rally coming out of it. Okay. Very good rally coming out of it. Very good rally coming out of it. So again, anything below minus 500 and definitely below minus 1,000 is a fantastic signal for a good return trade. And of course, we're getting extremely oversold, as you can see. Not as oversold as in the COVID low, but already pretty close to the 2022 low, etc. So soon the tide will turn. Okay, that's why I say, is it now time to short? Don't think so, but do whatever you want to do as long as you make sure you have very good stops in place. So that's that. Fear, greed, 27. Yeah, fear. I want to see extreme fear. That'd be fantastic. Mom and pops. Yeah, not yet fearish enough. 37.4%. Long term, we are looking at 31%. So I want to see this go into the 40s. That'd be fantastic. Okay. Then we're going to look a little bit at seasonality here. The Santa Claus rally, this is posted by Almanac Trader. Santa Claus rally fails to call, right? We did not get the Santa Claus rally last year. So the recent one. But the January parameter, JB, holds the key. So Santa was a no-show for the second year in a row. That's interesting. So all hopes for 2024 and 25 are not lost. We just have to look at how January is going to close. So here is the January indicator since the 1950s for the S&P 500. And I think if January is negative, then the year will have potentially negative returns as well. But the odds are not 100%, just 4 pretty much out of 16, okay? Or 5 out of 16. Depends a little bit on how you look at it, the next 11 months or the full year. So there is a little bit more increase in chance that the year will be negative, but it's not a given. So just have a look at January. What's January going to do? The Santa Claus rally wasn't great. Neither was it the previous one in 2023, but 24 was still a good year. You can see here, for example, 1991. You can see here 1985, still massive returns for the year. So take these with a grain of salt. It's just something to keep in the back of your mind and doesn't fit with the other wave. So this is where we are at currently. All right. Remember, big picture wise, we might not have topped at all. It would not surprise me. Okay. And that's kind of what I'm seeing here for the annual chart as well. Could this be the first miss out of 100 years of data? Well, actually, it is 110 years of data. Would this be a first miss that we're not going to see through 9 waves up, but we kind of stall at 7? It's possible. But for now, given that we've been able to track every single wave with this method, we have to give the benefit of the doubt to that this method works. So I still believe we're not done yet. We need to see a down year to label it 8, and then another up year to label it 9, which would match with Major 4, Major 5. Major 4 could be a down year, just as Major 2 was a down year, and then Major 5 is an up year, and then we'll probably see massive divergences, all that good stuff. All right. So keep this in mind. I'm not saying this is a given, but keep it in mind that this could very well be the case. Nasdaq 100, 20,400 plus or minus 100, potentially as low as 19,800. And S&P 500, ideally 57.75 plus or minus 25, which is still very nicely well within the ideal target zone of 57.37, 58.16. Okay, so today we finally got into the target zone. It took a couple of times to get there, and we're in it now. This is already what we looked at November, so we finally reached it. Unfortunately, it reached there in ugly fashion. It morphed a single zigzag into a double zigzag. Okay, so the warning levels for the bears are on the chart, and now we'll have to wait and see for the market where it wants to bottom out. This is the ideal target zones for these two indexes. Things are really washed out, but of course we have zero indication that a bottom is in place. Okay, that's really the bottom line message. I have zero indication a bottom is in place. Worst case scenario, I would say, is the ending diagonal. We see a bounce and then one final drop, which is still targeting right in the ideal target zones for the NASDAQ 100. Okay, that's the alternative I have at the moment. Take care, trade safe, and I'll see you all next week.